Very good afternoon, good morning. Welcome to live market analysis, FX week ahead outlook with myself, Giles Coughlin, Chief Currency Analyst. Hope everybody's doing okay and looking forward to taking us through this session. Now, just as folks are coming online, there's an awful lot to go through today, particularly as we understand what happened with the US dollar after the FOMC meeting last week. Looking forward to taking us through that, and understanding that narrative is going to be key to understand the dollar moves this week. And we have a very, very important data point out this week, which is the US inflation print on Wednesday at 1:30 UK time. I'll show us what to look out for, as well as which currency pairs look vulnerable to sharp corrections. So we'll be going through that, as well as other data points during the session. Don't forget, as we get going, any entries, exits that we talk about, they're always from an educational perspective. The key thing to understand, this isn't a signal trading service. Even though we talk about different instruments, different potential entries, exit points, it's from an educational perspective, and it's not a signal trading service because market conditions can change rapidly after this webinar. The workshop topic that we'll be looking at on Wednesday, and for those of you who just need a reminder, that is at 1:30 on Wednesday, 12:30 UK time on Wednesday, which is 1:30 UK time now with the clock change. We'll be looking at trading the US inflation data, and I'll be running through exactly what to look for and why we might be close to peak inflation and how base effects are impacting that data print due out on Wednesday. And if you're not sure what a base effect is, I'll explain to you what base effect is and why you need to know about it as a FX trader who's analyzing the markets. And I'll explain the significance of that on Wednesday. We'll now be looking at the dollar after the FOMC meeting. I'll give a rough overview, obviously, and I'll complete a story on Wednesday. We're looking at euro pound. What's the trade after the BOE meeting? Aussie US dollar. I'll explain why buyers are still in control, but I'll explain the ups and the downs of that outlook. US dollar inflation data front and center. We'll briefly cover that as well. China's 50. Last chance to enter medium-term longs. I'll show you what's going on with China's 50 index. Gold and silver. We'll take a quick look at those. Silver's at a very key potential turning point, well worth looking at, as well as what's causing the pound to sell and the symmetrical triangle breakout on the daily chart for oil. So we've got quite a lot of things to look at during the session. So without further ado, I will go over to my main screens, and we will start to look at what's going on. So first of all, we'll just take a little look at the calendar. Today, very weak day in terms of economic data. There's not much. We've just got a couple of speakers. We've got Fed's Bostich and Bank of England Saunders speaking today. Now, Bank of England Saunders is hawkish. Now, if you remember, at the last Bank of England meeting, the Bank of England have taken a dovish hike. Now, if you just want to keep up to date with the latest central bank moves, make sure you go to my blog and you're following the Central Bank Watch tab. So you go to Live Analysis, Market Fundamentals, Central Bank Watch, and there you can see these blogs are all written by me. Okay. So what's happened is a couple of things to point out. So after the Bank of England interest rate hike, they made a hike, but crucially, the Bank of England has revised growth to negative for 2023. And if you look at the SONIA futures charts, you see that as they dip lower, they're dipping lower because they're expecting lower interest rates now in the future, because the Bank of England are now expecting growth to fall negative in 2023. So that means the Bank of England will face pressures to cut interest rates in the future. That's why the pound started selling off heavily after the Bank of England meeting. And you see the euro pound gains, and we were looking at euro pound gains into the meeting. So well done for those of you who took advantage of that move. Now, the Bank of England also anticipate inflation to peaking at 10%. So the Bank of England's problem is the problem that many central banks are going to have, is that they're having to hike interest rates to contain inflation, peaking at 10%. But if they do that, then they risk slowing growth. And you can see that growth is due to turn negative in 2023. And the Bank of England are putting that down to a huge increase in global energy and tradable goods prices. So this is a stagflationary environment of high inflation but low growth. So in that environment, you typically expect the US dollar and gold to do well. So that's what's helping the dollar at the moment, post the FOMC. And that's what medium term should help gold. But the main factor for us to realize here is that the pound has been selling off strongly after that dovish hike. Now, you can see the selling in the pound last week, and that's also amplified by the dollar buying. Now, we are in some sort of key levels here, but that means Saunders is a hawkish Bank of England member. So that means if he says something sort of more negative, more dovish today, look for euro pound gains. Bostic, again, is a more hawkish member. So if we see signs of Bostic talking about worries about slowing growth, that the Fed may, slow down their interest rate hike speed, then expect that to weaken the dollar. So just watch out for those two central bank speakers. On the 10th of May, we've got some more Fed and Bank of England speakers. Again, we need to look with the Fed, any signs that the Fed will be hiking interest rates and they start to worry about slowing growth, then that means they'll be less aggressive in hiking interest rates, and that's a negative force for the dollar. The more that Fed speakers play up inflationary concerns, the more bullish that is for the dollar. Remember, you need to know what their biases are. So the way to trade central bank speakers is you want a central bank speaker to say something opposite to what they normally say to get a market reaction. So Saunders, for instance, the Bank of England, is a hawkish Bank of England member. So if he says something dovish, the market takes notice because it means there's a change. If a hawk says something hawkish, the market doesn't tend to react. So you need to know what's going on. And we've also got ECB's de Guindos. Now, the euro has been finding upside pressure, not in the euro-US dollar pair, because that's dominated by the dollar at the moment. And if you just don't know that relationship, let me just show you that relationship and how that works. It's an important relationship to get, because once you get it, it's very helpful to see. So there's actually sort of some hawkish pressures on the euro. But if you look at the dollar index, you will see this very clear relationship. There's a massive inverse relationship between the dollar index and the euro-US dollar. So do you see, when the dollar index rises, the euro-US dollar falls. When the dollar index falls, the euro-US dollar rises. So the rise in the dollar index has been pushing the euro-US dollar lower. Now, what we're looking for here, and this would be a great potential trade if we see weak inflation pressure on Wednesday. So if you just inverse this scale, the dollar index, sorry, let me just find it. Yeah, so just invert the dollar index scale. Do you see? This is the dollar index in the yellow inverted. So the euro-US dollar just does opposite to what the dollar index does. But there's been a whole series of very hawkish ECB speakers. Villeroy particularly was hawkish last week. And if you just take a look here, courtesy of the financial source interest rate and currency monitor, you can see here that the ECB are now expected to hike interest rates up to positive territory as early as June. 82% chance short-term interest rate markets are seeing a 10 basis points change, right? So that's positive territory by June. So that is good support for the euro. And if we see any sort of dollar selling, then expect euro-US dollar upside. So keep a careful eye on that development as we go through the week. On Wednesday, some very interesting data coming out of Australia. So you need to see how consumer confidence is in Australia. Now, remember, there's a very close relationship between China's 50 index, Chinese stocks, and the Australian dollar. Now, the relationship you need to know is that when Australia is doing well, and let me just correct myself, when China is doing well, the Australian dollar tends to gain. They have a very close correlation between the two, because China's economy, when it's driving forward, helps lift the Australian economy as well, because so much trade takes place between Australia and China that a growing Chinese economy is a strong driver for growth in Australia's economy. So let's see how consumer confidence is in Australia. The RBA took a hawkish shift at their last meeting. They start to see inflationary pressures as more serious. That's upside for the Australian dollar. At the moment, to start the week, we've had some negative sentiment for the Australian dollar. There was rising COVID cases in China. There's concerns that the latest Chinese data wasn't as strong as perhaps the market was expecting. There was a little bit of a disappointment in terms of the Chinese data out over the weekend. There is a almost stubbornness by Chinese authorities that they're maintaining that China COVID-free policy, which is, you get a handful of cases and you lock down large regions, and in some instances you lock down whole cities to try to stop and contain the spread of the virus, of COVID virus. Whereas in the West, they're relying on vaccinations, and here in the UK, life is pretty much back to normal because of the amount of vaccinations people have. For most people, not all, and sadly some people are still badly affected, but for the majority of people, life has returned back to normal. Whereas Beijing, China, they're having citywide lockdowns. So will that weigh on Chinese growth? It's starting to, and that's what investors are worried about. That's why we've seen weakness in China's 50 index. So you can see weakness in China's 50 index to start the week. Now, is there still a medium-term upside bias there for the pair? Well, yes, there is. Remember, we've got that very, very hawkish, bullish pin bar from the 14th of March. So, it is possible to buy with stops underneath 12,000, but that very long-term trend line. But the sentiment is negative at the moment because rising COVID cases and slowing growth. There's also, concerns that growth is going to be slowing globally. That will weigh on China's stocks. I personally like this instrument, and I bought Chinese stocks for like an expectant hold for the next 12, 18 months. Do you see that correction lower? From 15th of February, it's like a 40% drop. Now, typically when you get these sort of 40% drops, we had one in 2015, had another nearly 40% drop in 2018, another drop over here in 2013, right, 30%. So 30% recovered, 46% recovered, 33% recovered. Again, another slightly smaller drop here, 21% recovered. So I'm anticipating, recovery here. Now, it's all about the levels. So, there's no reason to think that, stocks couldn't correct all the way down, even lower. Sure, they can, but you can define and limit your risk to something like that 12,000. Area. So it's quite easy to define and limit risk. And so that's just why the Chinese data is very important at the moment. That now this data is just inflation and producer price index data, but it will be important for global growth sentiment. The main issue for Wednesday is the inflation data. Now, this is how you use the inflation data. You've got the forecast, you've got the low and the high. I'll come back on Wednesday and run through this in detail. Actually, it's at 1:30, so we'll look at the data live. I'll just get us ready for it now. Now, if you notice here, you see expectations for the year on year, the headline is expected to come in at 8.1%, and the core is expected to come at 6%. That is below the previous reading of 8.5% and 6.5%. Now, what you're looking for here is we're looking for a surprise to the downside to give us the best opportunity to trade the dollar correction. Now, at the last FOMC meeting, I was expecting a buy the rumor, sell the fact response. Now, that was the initial reaction after the meeting, but then we saw over Thursday and Friday, really Friday, as well, yeah, both days, we saw the dollar start to gain. And the dollar was gaining because inflation expectations were front and center. And investors are concerned that the Fed is going to have to hike aggressively in order to contain inflation. If you just take a look at, let me just pull up another tab here for you, and let me just show this to you here. I want to show you the interest rate expectation to see here that the short-term interest rates, look at this, they're now expecting a 75% chance of a 75% basis point hike. And you remember after the meeting, Jerome Powell said that, you know, yeah, we're not pricing in 75, we're not expecting to hike by 75 basis points. Well, short-term interest rate markets are, and they're putting a 75% chance of, at the 15th of June meeting, a 75 basis points hike. That is what's been boosting the dollar so much higher. Okay, dollar buying into last week, right? Now we're seeing a little bit of, is this peak dollar? This looks like it could be, really does look like it could be a peak dollar position. Okay, it really, really does. Looks very, very peakish. And if we do see, you know, the dollar sort of peaking at that level, this would be a key level. So it wouldn't be a surprise. You know, that's 2017 highs, 2020 highs. The Fed did nothing to take the dollar, you know, higher. So that means pairs like the euro US dollar, pound US dollar look very vulnerable to a correction upside if we have got peak bullishness in the dollar. So you can see here, euro US dollar, we could look, this is a Harami inside bar, potentially look for a break to the upside to take prices higher. Also looking at the Aussie US dollar, the RBA have made a hawkish tilt. Look out for a potential reversal from these levels. Now, the Aussie US dollar, for instance, you could enter there a bit speculative ahead of the FOMC with stops just underneath 6,950, but it's a bit of a risk. So ideally, what you'd want to see is you'd want to see a miss in this inflation print. So come Wednesday, if you see the headline come in below 7.9% and the core below 5.8%, expect the dollar to correct. And I would personally look for things like the euro US dollar upside, pound US dollar upside. And if there's a recovery in Chinese sentiment, look for the Aussie US dollar upside. If there's still negative sentiment around the Australian dollar and around China's COVID policy and China growth, then I would just look for the euro US dollar upside. That's what would make sense to me. Now, let's just look at what to look for here. Yes, and the other thing to look for is stocks. Now, if the inflation print comes in below market expectations and surprises to the downside, expect expect stocks to gain. So the go-to currency, the go-to index we look upside in the Nasdaq on Wednesday if we get a low inflation print, because that means the Fed are less likely to have to hike interest rates aggressively, and that's a better condition for stocks. So you'd expect stocks to gain on the back of it. So it's quite a straightforward playbook for the data, but like this is going to be crucial for the week. Inflation data. It's a major narrative, not only for the US market, but for the globe. High inflation is a bane of central banks. They're desperate to control it. That's the reason they're hiking interest rates. That's why short-term interest rate markets are pricing in a 75% chance of a 75 basis points rate hike in June, because they're expecting the Fed to be aggressive to hike interest rates. You see how all these central banks, apart from the BOJ, apart from the SNB, hike, 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 hike expected, right? 100% chance of the BOE for June, 100% chance of the RBA for June, 96% for the Bank of Canada, 50 basis points in June. You see the issue here? So that's what's really driving markets at the moment. And this inflationary print will be crucial on Wednesday. What you're looking for, below market expectations, below 7.9 for the year-on-year headline, below 5.8% for the core. That should be supportive. Thursday, again, we've got some producer price index pressure. Again, that's expected to go lower because of base effects. I think I'll explain that on Wednesday. And that's why CPI is expecting a lower expectation for the print on Wednesday. Again, the lower print that we get, the better that is for dollar weakness. So lower print, dollar weakness. Now, if it's high and above market expectations, will that boost the dollar? Yes, it will support the dollar, but remember, a lot of the dollar strength is already priced in. So the better opportunities and a miss. Friday, we have a couple of Fed speaker, Eurozone, Schnabel, de Guindos speaking. So the other thing to look at is German economic sentiment and ZU current conditions. Now, yes, a number of Eurozone speakers are expecting ECB rate hikes, but if we see a significant slowdown in German sentiment, that can weigh on the euro. Remember, Europe is very highly exposed to Russian-Ukraine risk. And if we start to see a big slowdown in German sentiment, and it already is slowing down, if it goes below the low, minus 47, minus 38, that will weigh on the euro. So that could give some more short-term downside in the euro. Look out for that. Germany is the largest producer for the Eurozone as a whole. So if German sentiment is weak, that drags down sentiment for the whole Eurozone. So that can be moving for the euro on Tuesday. A couple of things to look at we haven't looked at yet is the gold and silver markets. Now, gold and silver, we have a medium-term upside bias on the pair, right? And what we would need to see is if you see a disappointing inflation print, silver's at a great level. Look at this, big support level. You'd expect to find buyers on that support level. And if there's a disappointment on the CPI print on Wednesday, expect silver to push higher. Okay, definitely worth looking at silver. Stops could be put just underneath 21 if you wanted to be a little bit more kind of, speculative. Nothing wrong with having stops just below 21 for now. Gold. Is it still inflation hedge? Yes, if we see a stagflationary print, so if we have high inflation, but we have slowing growth prospects, that should support gold. The next level that I'm really interested in looking at is this level here, 1830, 1815. So you could expect buyers on a potential bounce from this level. That's reasonable. I wouldn't want to buy at this level, but again, you get a very weak CPI print on Wednesday, expect prices to move higher. Oil markets, very tricky to trade oil markets at the moment. You see that break of that level on the daily chart. There's a sort of a wedge that's got broken to the upside. We've got a retest today. We're finding some buyers. The problem is oil has different drivers at the moment. So driver number one is the Russian-Ukraine risk. That's what pushed oil higher at the end of February, beginning of March. That risk remains, particularly with the EU proposing a oil Russian import ban. If that's agreed, that should support oil prices higher. We also had that news from the US and the emergency strategic petroleum reserves. President Biden wants to add 60 million barrels to that reserve. That should keep oil prices bid. But on the other side, slowing global growth prospects weakens oil prices. So that's why we've seen oil prices sink today on the slowing global growth prospects. But if we see a very weak dollar on Wednesday, wouldn't be surprised to see oil pushing higher. Just to note, that is a very key technical level. So if people were having a speculative buy, buying at market with stops just underneath 105, 106 level, 105 is a very low risk, high reward area to potentially enter. Okay, folks. Remember, the last thing I'll close on is, if there was a currency pair to trade on a, kind of risk reversal. So say, for instance, all of a sudden President Putin declares peace between himself and Ukraine. It's the end of the conflict. Then you expect the euro-US dollar pair to surge higher. You can see, at the end of February, do you see how at the end of February, the euro sunk from what? 1.1250-ish down to about 1.0850-ish, maybe, you know what I mean? So 300 plus point drop. If there's a sudden peak, expect a 300, 400 plus point rise. That's what we expect. So that's things like that. Okay, folks, it's been an absolute pleasure as always. Do not forget, if you want to follow along to my Twitter blog, do follow me along at Giles Cochran CCA. You can see my Twitter handle here. I'll just put it into the box. Follow me along there at Twitter. You can also follow me along at LinkedIn. And don't forget, this is my blog, and make sure you read this blog because I constantly update it with details every single day, and I'm always on top of central banks. So, I covered the RBA, I covered the BOE heading into it, and I'm always trying to stay ahead of the game and looking ahead to events. And I've just written the FOMC piece, which should be out either tomorrow or Wednesday. So there's plenty there for folks. So I hope that helps. Thank you all very much for your time. Glad you could attend, and have a very good rest of the session. Thanks everyone now. Goodbye.